Okay, so let's go ahead and just dive right in. Here's our agenda for today. We've already gone through the introduction, so I'm not going to spend a whole lot of time on that. The blockchain is not crypto segment. There are several sections I do want to go over. How do we get here? Who are the parties that were involved? What now? Consolidation, regulation, innovation, and then status of some of the blockchain projects that are out there. And also a little bit on what's been taking place within the financial services industry lately. So Susie did a great job of introducing me, so I'm not going to spend a whole lot of time on my background. I did want to speak a little bit more about Zventus. Zventus is a global services and consulting company. Our goal is to deliver world-class business and technology services by inspiring and nurturing the highest quality talent around the world. We have deep industry expertise in mortgage, insurance, health services, and technology. Okay. When I first started speaking about crypto, I used to preface my presentations with the statement, blockchain is not crypto, and always with a lot of emphasis. The recent turn of events have made me resurrect this admonition. So you're going to keep hearing that from me. Blockchain is not crypto. Crypto is an application of blockchain technology. If you follow the crypto markets, you've seen plenty of volatility, and that volatility reached new heights in 2022. Last year was a tumultuous and challenging period for the financial services industry as a whole and for the mortgage industry. In the preceding years, crypto was an exciting and new technology. Crypto mortgages was an innovative and growing product. However, the promise of crypto mortgages ended abruptly with the collapse of the crypto market. We're going to delve into this today and try to answer with what happened with crypto. How did it impact the mortgage market? And what does it mean for the future? To gain insight into that decline and the impact on mortgages, we need to first identify and understand the entities involved. Although the collapse started in May of 2022, we need to go back to September 2017. This is when a young Samuel Bankman-Fried started Alameda Research at the age of 25. Alameda Research was a quantitative trading company. It found its initial success arbitraging the difference in the price of Bitcoin between the US and Japanese markets. Bankman-Fried then started FTX in April of 2019 as a crypto exchange, and Alameda Research became the market maker for FTX. In addition to generating revenue through trading fees, FTX also sold its own crypto token, FTT, and that token allowed customers to trade on FTX at a discount. A couple things to note, FTX would eventually operate through a network of 130 affiliated entities. Also, Bankman-Fried still owned 91% of Alameda Research, but he was adamant that Alameda did not have any special privileges at FTX. So in addition to the FTT token, we'll also discuss Terra USD and Luna cryptocurrencies. Luna and Terra are the two native tokens of the Terra network, a blockchain-based project developed by Terra Labs in South Korea. Terra was a stablecoin, a coin designed to hold its value at $1 based on a pseudo arbitrage system and community faith in the Terra ecosystem. Instead of relying on a reserve of assets to maintain their peg as USDC and USDT2, these are other stable coins, Terra is an algorithmically stabilized coin. In this example, Terra is a stable coin and Luna is what's called a governance token. The interaction between the two is intended to keep Terra's dollar value steady. This involves a smart contract-based algorithm to keep the price of Terra anchored to $1 by burning or permanently destroying Luna tokens in order to mint or create new Terra tokens. In the Terra ecosystem, users could always swap the Luna token for Terra and vice versa at a guaranteed price of $1, regardless of the market price of either token at the time. This is important to note because it means if demand for Terra rises and its price rises above $1, Luna holders can bank a risk-free profit by swapping $1 of Luna to create 1 Terra token, which due to a rise in demand in this example, it's worth more than $1. However, the weakness in this algorithmic stablecoin is if there are a lot of sellers of both Terra and Luna, the next price for Luna will logically go lower, despite the supply balancing smart contracts. In other words, the velocity and force with which Terra is declining overwhelms the ability of the smart contract algorithm to compensate and rebalance. And in May of 2022, this is what happened. What began with 2 large withdrawals from the decentralized exchange Curve Finance, totaling around $250 million, became a torrent in the following days. On May 7th, over $2 billion worth of Terra was unstaked or taken off the Anchor protocol, and hundreds of millions of it were quickly liquidated. Now, there's a debate as to whether this happened as a response to rising interest rates or if it was a malicious attack on the Terra blockchain. There's an even more interesting, I don't know if you would call it a conspiracy theory, but it's a theory that the collapse was a George Soros type of attack, which, if true, this would have netted the attacker a $1 billion profit. But regardless of its genesis, the huge sell-off brought down the price of Terra. As a result, crypto hedge fund Three Arrows Capital collapsed, and we'll talk about why in the next slide. And then through contagion, this helped cause the downfall of several crypto banks, Voyager, Celsius, BlockFi, and so on. As these events were unfolding, Bankman-Fried helped bail out Voyager and BlockFi and was considering relief for Celsius. As a result of these events, investors and research companies began to take a closer look at crypto companies. As a part of that increased scrutiny, CoinDesk obtained a copy of Alameda's balance sheet and noted a large amount of FTT and that FTX's FTT assets were loaned to Alameda. On November 2nd, CoinDesk published a report questioning the financial health of both FTX and Alameda. Changpeng Zhao, the billionaire founder of rival exchange Binance, said he would sell his FTT tokens. Customers panicked and started yanking their money out, causing a good old-fashioned bank run. Unlike George Bailey's Building and Loan in It's a Wonderful Life, FTX, strapped for cash, agreed to sell itself to Binance. However, Binance quickly changed its mind as issues arose doing due diligence. And this is where I think we've read quite a bit of it in the newspaper, so I'm not going to go too far down that rat hole. Bankman-Fried stepped down on November 11th as CEO of FTX, and FTX filed for bankruptcy that same day. Within hours of filing for bankruptcy, FTX said it was the victim of unauthorized transactions and that it would move its digital assets to cold storage for security purposes. Outside analysts said that they suspect that about 477 million was stolen from FTX in this alleged hack. Now, recall from the previous slide where Bankman-Fried was adamant that Alameda received no special treatment from FTX. In bankruptcy, regulators found that there were backdoors that allowed the transfer of funds from FTX to Alameda. It was also during this time that one news source printed one of my favorite headlines of the time: FTX finds $5 billion in liquid assets. So how does one exactly find $5 billion? And more importantly, how does one lose $5 billion, since this is not an insignificant amount? But I'm going to leave that alone. Okay, this graphic shows the reach of the FTX contagion, where over 1 million depositors, creditors, and investors were impacted. Remember in the earlier slide that FTX had a network of 130 affiliated companies, with a major exchange and trading firm under its umbrella, many loans to and from other players, and various tokens with market values once in the billions of dollars. FTX's tentacles extended widely across the financial services industry, including the mortgage industry. One connection is Silvergate Capital, and that's in the lower half of this diagram. At the time of the collapse, FTX had $1 billion deposited at Silvergate. As an indication of the importance of this relationship, Bankman-Fried said, quote, "Life as a crypto firm can be divided into before Silvergate and after Silvergate," unquote. So what was Silvergate? Silvergate was one of the first banks to work with crypto clients, branding itself as the leading financial institution in the digital asset space. This company rode the crypto boom to great heights, with its stock gaining more than 1,700% from its $12 initial offer price in 2019 to a peak of $220 per share in late 2021. That's a phenomenal growth. Unfortunately, the shocking collapse of its top clients, FTX, led to $8.1 billion in withdrawals near the end of last year. Other examples of FTX's reach that fall into this diagram include the following: crypto lender BlockFi, which got a line of credit from FTX in 2022, and they followed FTX with their own bankruptcy filing. Genesis Global Capital, which had loans outstanding to Alameda. And then Singapore-based Three Arrows Capital, which we mentioned briefly already, a cryptocurrency hedge fund, which was reported to have $10 billion in cryptocurrency earlier in 2022, and then began bankruptcy proceedings in June of 2022. Three Arrows Capital, or as they were called, 3AC, had exposure to Luna, and in the words of one of its founders, who is a king of understatement, quote, "The Terra Luna situation caught us very much off guard," unquote. And then the last example of FTX's reach, Voyager. I think I briefly mentioned them already. They were a New Jersey-based crypto lender. They filed for bankruptcy in July, and the primary reason they filed bankruptcy is that 3AC defaulted on a crypto loan to them of over $650 million. So that was a little bit on the morass that was the different crypto organizations and the impact of FTX. Let's drill down a bit on crypto lenders and crypto loans or mortgages. A crypto-backed loan uses digital assets as collateral, comparable to using physical assets like your house for a loan. The benefit in a crypto loan or crypto mortgage is that the buyer doesn't have to sell his or her crypto assets to execute a purchase. Crypto is not a legal tender issued by the government. Therefore, it doesn't meet the good fund standards for disbursement and other closing related fees. And many title insurance and settlement providers just do not accept funds in crypto. A consumer may not use crypto directly to buy or pay for a home, but a consumer can use crypto as collateral for a loan. As I mentioned at the onset, crypto mortgages were a growing area, but the collapse has certainly limited the use of crypto mortgages. Companies that offered crypto mortgages but have since declared bankruptcy or just shut down include Salt, I already mentioned BlockFi, Nexo, WeTrust, SpectroCoin, Unchained Capital, and I'm just going to stop right there. There are quite a few others. However, there are companies that are still offering crypto mortgages. That includes Milo, USDC.Homes, Figure, and Ledin. So although crypto mortgages may be diminishing, there's still an active market out there. Okay, crypto's impact on the mortgage industry can be viewed in three different ways. We've already talked about the companies that have shut down, the crypto mortgage companies. So this obviously is consolidation. As I mentioned, key players that have gone bankrupt include FTX, Alameda Research, the crypto lenders, Silvergate Capital, I mentioned them, Signature Bank, and others. However, as a result of those companies closing and the collapse, there are tens of thousands of customers at crypto lending companies waiting to see if their assets can be recovered. Unlike traditional US bank failures, which we've just seen within the past week, where the government insures customer deposits up to $250,000, there's simply no mechanism for depositor insurance in the largely unregulated world of cryptocurrencies. Also, the mortgage industry has always been a laggard in the utilization of technology. The volatility and risk stemming from crypto has caused the mortgage industry even greater hesitancy around crypto and by association blockchain. I recently spoke with a mortgage executive that said that to him and his company, crypto and blockchain are radioactive. So that's a significant hill that blockchain enthusiasts need to climb. Okay, this aversion is evidenced in this diagram and in the reduction in the pace of investments in crypto/DeFi. Aggregate deal value, as shown in this chart, has decreased from over $5 billion in Q1 of 2022 to just under $1 billion in Q4 of 2022. Also, the number of deals has decreased over that same period from a peak of 160 to 60 towards the end of 2022. So one of the most obvious impacts, fewer crypto mortgage companies, and this may even lead to crypto mortgages disappearing as a product. We'll wait and see in the next couple of months. And another impact, as evidenced by this chart, fewer investments in crypto and blockchain companies. And also, I don't think I need to say this, but I'll say it anyway. Selling blockchain solutions has become extremely challenging. Okay, the second impact of the crypto collapse is increased regulation. I'm just going to go over a couple key examples that I've identified in my research. Fed Reserve SR 22-6, engagement in crypto asset related activities by Federal Reserve supervised banking organizations. There's really two aspects to this regulation: legal permissibility and notification of proposed activities. So permissibility. Prior to engaging in new activities of any kind, a supervised banking organization must ensure that those activities are legally permissible. As soon as I read this, I thought, isn't that kind of obvious? But again, we're going to leave that one alone. Notification of proposed assets. A supervised banking organization should notify its lead supervisory point of contact at the Federal Reserve prior to engaging in any crypto asset related activity. Again, something that I think is one of those apple pie and motherhood type of regulations. There's also the joint statement on crypto assets to banking organizations. As the name implies, this was a joint statement put out by the Board of Governors of the Federal Reserve, the FDIC, and the Office of the Comptroller of the Currency. This document states that the agencies are continuing to assess current and proposed crypto asset-related activities by banking organizations. Again, motherhood and apple pie. It also cautions that issuing or holding principal crypto assets that are issued, stored, or transferred on a network or similar system is highly inconsistent with safe and sound banking practices. And then the last item on this statement is this also had a notification of proposed activity. So if an FDIC supervised institution were to engage in crypto-related activities, they need to notify the FDIC. The other item that I wanted to mention in terms of regulation comes from the European Union. Don't want to leave those guys out. MiCA MiCA was intended to close the gaps in existing European Union financial services regulations. So it's intended to apply a consistent set of rules for crypto assets and related activities that really focused on three items: protect crypto investors, maintain financial stability, and promote widespread innovation within the industry. So MiCA imposes restrictions on the issuance and use of stablecoins specifically. And also MiCA was a part of a broader digital financial package, which included the Digital Operational Resilience Act, or DORA, DLT Pilot Regime Regulation, which itself starts in, I think, March 23rd, 2023. So those are some of the samples of regulations. But the last bullet on this slide, I did want to mention the Federal Reserve recently denied the application of Custodio Bank, a crypto company, and did not allow them to join the central bank's payment system. So regardless of what all of these regulations that we've gone through, and these are just the tip of the iceberg, regardless of these regulations, I think that last bullet, that last item really hints at where the regulatory bodies are going, where the Fed's going. So just keep that in mind. The third, and I think the most relevant impact of the crypto collapse is on innovation. One would think that the crypto collapse would freeze innovation. However, since I'm an eternal optimist, I believe that the increased reticence around crypto will shift the focus from the speculative uses of crypto to the more pragmatic utility of blockchain. This includes, and it's not limited to, Web3 or the metaverse, consortiums, AI, and machine learning. An excellent example of innovative AI we've all heard about, ChatGPT. There are some great examples of pairing blockchain with AI, and they include the following: smart contract development, natural language processing, and DAOs. So let's first start off with smart contract development. ChatGPT can generate sample code snippets that can be used to implement a contract's logic. Natural language processing. Again, ChatGPT can be used to generate natural language prompts and responses for chatbot functionality with the distributed app, or DApp, allowing users to interact with the decentralized application using natural language. This, I think, has the potential to be very, very powerful, and I'm really excited to see some of the companies out there. And then the last one, DAOs, or decentralized autonomous organizations. By using ChatGPT or a similar AI, you can build and manage smart contracts, and it will be possible to create DAOs that are able to operate independently and make decisions based on those predetermined rules and algorithms. So again, that's something that I think is really exciting. Some examples of some of the companies that are using blockchain in the mortgage industry and are touching upon some of these that we just discussed. Smart Realty, founded in 2017, they use smart contracts to facilitate peer-to-peer transactions in the US real estate market. So I think what's really unique about that is the peer-to-peer transactions. SafeWire, it uses a solution to increase the wire fraud challenges that real estate agents, clients, and companies face. The SafeWire solution operates via a blockchain network and ensures security over those vulnerable transactions. Propy, another real estate technology solution using smart contracts for enacting international property transactions. The company's platform facilitates buyers, sellers, and uses, again, a suite of smart contracts that speed up the real estate process. Vert is another one. They're an all-in-one real estate marketing solution. Some of the feedback that I've heard on Vert, I haven't used it myself, is that it provides an exceptional customer experience. It also provides a crowdfunding platform for investing in rental income generating properties and tokenization and liquidating real estate assets. And then the last one is Property Club. In 2018, this company launched a real estate marketplace that uses blockchain and smart contracts. It provides a safe tokenized property exchange and uses crypto rewards. So these are just a sample of some of the companies that are still using blockchain in the mortgage and real estate market, and I'm sure there are more out there. Okay, some of the developments are listed on this page, and these developments support what we've been discussing. First, the crypto collapse has hampered the use of blockchain in the mortgage industry. Investments are decreasing, and I think crypto mortgages will continue to diminish as a mortgage product. And second, despite this negativity, blockchain can still be a useful tool, as some of these items on this page have demonstrated, and we'll go through each of these items. So first, let's talk about Figure. So Figure is a fintech company. It had planned to merge with a mortgage bank via a SPAC, or special purpose acquisition company. This deal is essentially dead and wound down in December 30th of 2022. Figure also tried to merge in June with Homebridge Financial Services, but this transaction was canceled when it failed to get regulatory approval. But Figure is still a key company in the mortgage industry that utilizes blockchain technology. So despite what these bullets say, Figure is still a force to be reckoned with. Another item on here, tokenization. As we were going through those companies on the previous slide, tokenization was a key offering for a lot of those companies. Tokenization continues to be an exciting use of blockchain, and it seems to be gaining traction. For example, a gentleman at Casper Technologies, he said that the use of tokenized mortgages could prevent the next housing bubble. This is definitely something to keep an eye on. I haven't had a chance to delve into this one, but hopefully I'll be able to speak with one of the gentlemen at Casper Technologies about this. Their solution entails smart tokens. And this means the financial agreement has to be machine readable, and the various parties involved must agree to the code itself. Otherwise, differences in interpretation and analysis will continue, causing future disruptions. There's even the possibility of double tokenization. So stick with me on this. I'm not sure I absolutely understand it myself. Double tokenization is where mortgage tokens are wrapped inside of a larger token to create a tokenized mortgage-backed security. This will provide, and I'm reading directly, quote, provide transparency to not only the pricing and ratings of the MBS, but also transparency and ratings to the underlying mortgages, unquote. So that sounds fantastic, and then I want to get more information on this. It does double tokenization and tokenization in general, and smart tokens, they are dependent upon transparency and open standards. So that's one thing to keep in mind. Another recent development, maybe not so recent, but it was recent for me, SunWest Mortgage. They deployed a new version of their blockchain real estate platform called Morgan. Morgan's AI technology converts a pre-approved property-specific loan to a property agnostic tradable NFT. So, and also this token is backed by real dollars and guaranteed by SunWest. So both of these, I think, make that a really compelling product, and I'd be really interested to see how that develops. In addition to the NFT capability, SunWest claims that its blockchain-powered platform has streamlined its mortgage approval process and helped speed up the loan application review process to within 30 minutes. Okay, so let me repeat that. They've sped up the loan application review process to within 30 minutes. Now, in just going back to what benchmarks we're seeing within the NBA, 30, 45 days, now 30 minutes because of blockchain. I'm sure a lot of you are saying the same thing that I said when I first read this. Okay, show it to me, prove it to me. But again, this is something that's very exciting. So these examples are meant to demonstrate, as I mentioned at the beginning, that there are still quite a few companies within the mortgage industry that see the promise of blockchain and I think are actually pursuing its viability. One last thing that I wanted to mention on here, and it's a bullet that I included at the last minute, was Silicon Valley Bank and First Republic Bank. Frankly, I don't think there's a direct link between crypto or blockchain and what's happening with SVB. So if anyone has any insight into this or they feel differently, I'd welcome a discussion. I'm really interested to keep abreast of what's happening with these banks, but I don't think it's related to crypto. Then the last item on this slide, I did want to mention that if you're interested in learning more about blockchain and the mortgage industry, I invite you to attend our monthly Hyperledger mortgage subgroup meeting. It's held on the second Thursday of every month, and this link here is to that group wiki. It includes an overview of our charter, previous meeting notes, and recordings. We also provide a curated list of the developments within the mortgage industry.